So we got the jobs report, everyone expecting a certain number. We've got some really good data from overseas as far as rate cuts and things that could be coming. But the Bureau of Labor and Statistics added again with data that has a lot of discrepancy, a lot of people questioning. And as a good friend of mine, Barry Habib said, maybe only data that a fool could believe. Hey everyone, it's Rayce Robinson, your favorite Florida mortgage broker, and I want to dive into these numbers on the jobs report and why we care about these numbers, especially when it comes to unemployment, is in the real estate world, whether you're a real estate investor thinking of buying a home, selling a home, or like myself in the real estate world as far as employment goes, where I work, I'm a loan officer, and these unemployment numbers are one of the things that are affecting interest rates because the Fed is emboldened to keep rates higher for longer if they feel like the job market is not broken, meaning there's not a lot of people losing their jobs. Because obviously their main goal is inflation, and if they keep rates higher, that's better for inflation. As they lower rates, make money cheaper, that makes inflation go higher. And that's important because there are a lot of people sitting on the sidelines waiting to buy a home, hoping that rates could drop. So we're going to take a look at some of these numbers and why it's important, because data, the way you measure it makes a difference, and sometimes the reality is different than what the data shows. Now, more importantly, when you look here, I found this article about existing home sales recessions hit so hard that we're back to 1978 levels. And I want to show you how much actually demand has fallen off. So this is, when rates were really low, but you can see we always hover, even before that, right around 5.3 million to 5.5 million transactions, 6.1 million during when things really boomed, and now we're all the way down here to 4.1 million transactions in 2024. This is what Goldman Sachs is predicting through 2027. Now, I personally think that that is not correct as far as some of the assumptions they're making. But again, not everyone agrees with Goldman Sachs. I actually don't either. And the main reason, when you look at what they're saying here about rates, Goldman Sachs thinks the average 30-year fixed rate mortgage will fall to 6.5% by the end of 2024 and 6.3% by the end of 2025. Now, no one has a crystal ball. I actually think some of the data we're going to talk about today, that the market and unemployment, some of the things, I've been saying this many times, we'll see if this ages well, that rates will fall faster than what people think. I don't really know. And Goldman Sachs thinks that rates will be at 6.3% by the end of next year, meaning that regardless of how many people will enter back into the market, they are saying that we're at the bottom and there's going to be more and more transactions every quarter as we go on. And I think there'll be more than what they're saying. So what was the big news? The other central banks, so Bank of Canada cut their overnight interest rate, and the Eurozone cut their interest rate. They gave us kind of a mixed bag where they actually cut from 4% to 3.75%, but they also said that inflation was likely to remain above the bank's 2% target. And why that's important is because they're actually saying, yeah, we're going to lower rates, but we're still worried about inflation. And a lot of times our Federal Reserve and the ECB will do these things in tandem. So the thought was this could be setting up a potential rate cut as far as our Fed goes, at some point this year. Now, everyone is predicting some rate cuts this year, but everybody's predicting different things. One of the things that's interesting is there is a big discrepancy on what other people are predicting. See Goldman Sachs on their predictions on demand. Citibank actually came out with a pretty bold or bearish, outlook as far as the Fed funds rates go. Citibank says Fed likely to cut in July after a strong PCE report. And they're expecting that we could fall 100 basis points in cuts this year. And I believe I read another article that they could be 200 basis points over the next 12 months. That is a bold prediction. We'll see how that ages, because really no one else thinking that we're going to get those kinds of rate cuts. And remember, when it comes to cutting interest rates, it's a sword that cuts both ways, so to speak, because if the economy is doing worse, this is a general statement, but in general, if the economy is doing worse, that's when the Fed cuts rates. So when you think about when rates are really low, that's because the Fed is trying to help the markets. And so in general, If the Fed is lowering rates, that's because they're worried. They're worried about unemployment. They're worried about the market decelerating too quickly and all these things. And so they're lowering rates to help. So that just means as rates are lowered in some sectors, some people not having a great time. And when we look at the actual prediction for rate cuts, you can see in June, 99.4% of the people believe that we will stay the same on the Fed funds rate. And if I do go to July, 8.1% of the market believes that we could get a rate cut. 91% still believing that actually rates will stay, the same throughout really kind of the summer. August and September is where you see the other people, the other big players in the market predicting potential rate cuts. Now, I want to look at this jobs report because it is kind of really, really interesting. I'm not saying people are manipulating data, but I am saying it's a little bit strange. Okay, so there's a lot of speculation on this May BLS report on the jobs, on job creation, so they call it the jobs number, and it really shows how many jobs are getting created every quarter, really every month, and the prediction was for us to get 185,000 new job creations. And a lot of people thought the number would come under that because when you look at a lot of the data just nationally and internationally, a lot of people feeling like the market is decelerating. And I've already did a video once on how the BLS and actually with rent equivalency and CPI, they changed without telling anyone how they calculated those numbers and threw those numbers off. So the models that they use and the way that they can do it can definitely make a big difference in the data. So we were expecting 185,000 new jobs to be created, but there was actually 272,000. That is a red hot number compared to what was believed to be happening. Now, it's very hard to measure job creation if you think about that when there's something like 167 million people in the workforce. So it gets a little complicated. They send these surveys out to big businesses and they answer these surveys. So that already is kind of tough, and the businesses or the bigger ones have gotten worse and worse at answering these surveys. So they also use this model called the birth death rate. I'm not an economist, but basically they look at the birth creation of new businesses and the death of existing businesses, and try to figure out how many jobs were created and how many jobs were lost through this birth death model. And this model showed 231,000 in job creation through this model. Now ADP, which I think is a better measure, or the big payroll company, measuring around the same time frame, similar cohort of businesses, they showed minus 10,000. So that's a big difference between what the BLS is showing and what ADP is showing as well. And when you look at the household survey, where they actually call and speak to different households, they showed minus 408,000 jobs. Now there's this weird number that they track, like people that are in the labor force and people that leave. And so when you looked at the numbers, 250,000 or so left the workforce, meaning they haven't really looked at a job in the last 4 weeks. And when you look at the real numbers, a lot of these numbers are confusing because they don't count certain things that really don't make sense to me. If you look at this U6 number, which no one reports on, shows 7.4% in unemployment, a lot higher than I believe the 3.9% or so that the Bureau of Labor Statistics is showing. But it just shows that there's a big discrepancy in what probably the actual data could be and what this BLS or the Bureau of Labor Statistics is showing. And also the QCEW report, which is the quarterly census data for employment and wages, showed 800,000 less jobs than the BLS reported. Just meaning that you have the European banks cutting their Fed funds rate. We've had a lot of numbers come in on our end as far as looking at CPI and some of these things where you could see the Fed setting up for rate cuts faster than what people think. But then you get this unemployment data showing the job market is really strong. And so the bond market really not knowing how to react to that. And that is really what affects interest rates. And you can see this chart here on rates where we've been kind of this up and down trend. We've not been able to break below this 7%. And I really felt that we would break below the 7%. Freddie Mac said we kind of did, but then the bond market reacted negatively to this data that came out with the jobs report. And so the week ended kind of up on rates, still just above that 7% rate. Now remember, everyone's rate's different. You can buy it down and people have different credit scores. I just use the same measure every time, the Mortgage News Daily. You can look it up yourself just to get a general trend of where rates are at. It's really hard to time the markets, but I've been doing this a long time. I pay attention to the details as far as what's going in the market and why that matters. When you do buy a home, you do want good, sound advice on should you be floating or locking? Should you be paying things called discount points to buy the rates down? That's where this stuff can really make a difference. But as far as timing the market on when to buy, there's never been a better time than right now. Why? Because there's so many good programs that are helping buyers, little lower rates, helping with down payments. And look, if rates fall, that's when you want to refinance and not be competing against everybody else that's going to jump in the market when that happens. And if you're like me in the industry, working as a real estate agent or in the mortgage business, focus more on your daily success plan than what the numbers say, because at the end of the day, what we do every day is what's going to determine our success. So if you have any questions on this, building a daily success plan, the numbers, or just want to get some mortgage advice on what to do next as far as building a plan to buy a home sometime in 2024, reach out to me. I'd love to help. Hey, this is Rayce Robinson, your favorite Florida mortgage broker. As more information becomes available that moves the market, as always, I'm going to cover it right here. Have a great day, great week. Talk to you soon.